Hi, everyone. This is Jeff Praissman. It's my pleasure to welcome back for our monthly podcast, Market Chameleons, Dmitry Pargamanik and Will McBride. Hey, guys, how are you?
Good. Hey, Jeff, how are you?
Hey, Jeff. Thanks for having us back.
My pleasure. And we just got done a great webinar on single leg options, and I'm excited to take a deeper dive or a different dive, as we like to say, on this podcast format that we get to do every month with you guys. I'm just going to kick it off. Dmitry and Will, could you explain what makes single leg index option analysis particularly valuable compared to analyzing multi-leg strategies? And also, how does isolating these trades provide clearer signals about market sentiment?
Yeah, thanks. So when we talk about the single leg options, these are option trades. These are orders that were entered in as a single leg order, either a call or a put, buying a call or put, and executed like a single leg order. And that's different from multi-leg trades because you can enter in a trade. You could enter in a call spread, a put spread, a butterfly, where all the legs have to get executed simultaneously. And when we look at strategies that are multi-leg trades, that could be telling us something completely different, signaling a little bit of or some different type of trade or expression in the market. And if we isolate those out and just analyze the single leg trades, then we could really get a sense of how people are using options differently, and then take that trading volume and analyze it in itself to get an indication. What are people doing? How are they using options? Where are they trading? And how is it impacting the option premiums and implied volatility from those trades? So that would be the important piece, to just separate that volume so you could get a clearer signal of how people are using the option.
And we often hear about put-call ratios. MarketChamelion's research goes deeper into volume distribution about by moneyness. How can traders interpret the difference between heavy volume and far out of the money options versus at the money options? And what do each of them typically signal?
Yeah, that's a good question, where you could have a lot of calls trading, a lot of puts trading, or an even amount, and places where those options are trading makes a big difference. So when we were talking about, let's say there's a lot of volume around the at the money options, where it's options with strike prices that are close to where the spot price is. And usually that happens. It could be directional, or it could be a volatility type of trade where people are expressing the implied volatility of their opinion on the stock. And as you go out further and further, those types of options, let's say wings or tails, are something a little bit different, where people are not any longer expressing an implied volatility opinion as much as a larger stock, perhaps, or in the case of a tail, it could be for protection or something where an expectation is something not related to just market gyrations back and forth, but more of a large move to that strike. So by looking at the moneyness, those are typically different types of expectations and behavior. Either could be something very speculative, or it could be a hedge, but to protect perhaps from a violent, unexpected, or unusual.
And when analyzing expiration hotspots, what patterns have you noticed around, say, economic events like FOMC meetings or CPI releases? And how can traders use this information tactically?
Yeah. So when we look at different options expirations, what we look at is what expirations are traders concentrating on, what are they doing, and what can cover that expiration. So perhaps, like you mentioned, if there's a upcoming event in the market that is known about an upcoming release, because we could get a schedule of Fed meetings and so forth, and what are people doing in the options market? What are their expectations around that event, and how much trading is there? Is there a concentration of heavy volume in a particular expiration that, let's say, covers the Fed meetings? And then we could look at that to see, well, what's the distribution of that volume, and what are people signaling, or their expectations of a volatility move, or is there a particular strike or option type that is seeing some concentration or unusual volume?
And MarketChameleon's developed methods to differentiate between retail and institutional order flow in index options. What What are the most significant behavioral differences you've observed between these two groups? And maybe as important, like how can retail traders benefit from understanding institutional flow and positioning?
Yeah, at least from just a observation through day to day, what's interesting is that we see all types of traders participating in something like the SPX index, small traders, retail traders of different sizes, and even institutional traders. Every day we see volume coming from all types of traders. And if we just from eyeballing and looking at the patterns, it looks like the small and retail traders tend to go for zero DTE options almost on a daily basis. That's what we see is that there's zero DTE, 0 days to expiration options that expire same day. So you don't have the overnight or carrying risk of the options. And typically we also, the larger trades, just the larger trades that we pluck out, go out a little bit further. Those would be going out further months, and they could be either based on some strategies or buy rate strategies, or their strategies of hedging overall portfolio risk. So you tend to go out further, especially if you're trying to hedge it out in time based on some expectations or news. So we see like the larger trades happening in options that are further out, not necessarily leaps, but they're not zero DTEs all the time. And that would be like the first observation. And I think just for any trader, whether you're a retail or professional trader, it's important to know the market dynamics and what's trading and what people are doing. So showing up, you have a board, right, of all this information that you need, that is part of your decision-making process, right? And knowing the different players, what they're doing, how it's impacting markets, where is their concentration or heavy volume and who's doing it, it's all important for any trader just to understand what's going on.
That kind of leads me to my next question. When you identify these unusually high volume and specific strikes, what other factors do you investigate to determine whether it's a hedging, speculation, maybe part of a larger strategy that's not immediately obvious, or is it just sometimes you just don't know?
Yeah. No, you're drawing inferences. You don't really know the intent of the other side because you don't even know who the other side is. You could see the size of the trade, but you don't know who the person is on the other side. You never know that, but you could draw some inferences based on other related key metrics. And one is implied volatility. How are the trades impacting the option premiums? Or is the implied volatility going up? Is it going down? Is it impacting skew? Is it impacting trading in other related options? Is it making the tails move up, down, flatten the skew? So all this plays into overall inference of what you think is going on. So taking the trading volume and looking at other surrounding data paints you a better picture where how much trading is going on in other places and how's that impacting the option premiums.
And implied volatility is such an important factor of options. And you just briefly spoke on it, but how is the relationship between implied vol and single leg options? Has it evolved in recent years, or are there any predictive patterns that traders can use or should be watching that they can extrapolate the data from?
Yeah. If we just look at I guess, the implied volatility, when you look at any product from day to day, you get used to how the implied volatility looks like from day to day in a particular stock and the skew. In an index, it always looks a little bit similar, the vertical skew, where the option implied volatilities to the downside are always sloping higher because as the market goes down, the expectations are usually built in that the volatility will start increasing. And as expectations, if the stock market goes higher, the implied volatilities are usually sloping down with expectations, volatility will decrease. So that's like a kind of typical smile that you see in the SPX, but it does move around and things shift. It could become flatter, it could become steeper. So those are things that you want to keep an eye out for how how it's moving around and what's making it move around that way, or what's making it go steeper or flatter.
And Dmitry, our listeners love real situations. You will have been involved with options really for the last 30 plus years. Yeah, I wonder if you
Yeah.
could take us through maybe a recent or not so recent case study where you were analyzing single leg option volume and it provided an early signal about market direction that maybe wasn't reflected in the underlying price, or just a real world situation that you share with our listeners.
Yeah. So as far as index options goes, that's something the SPX, it represents the SP 500, the market. So nobody knows where the market's going to go, or nobody should. That seems for one person to really know where the market's going, or the institution would be it seems like it would be something that you shouldn't be able to do. But some of the things that we do, or you could look out for, is how the implied volatility is changing, because implied volatility is starting to signal that, hey, something is expected to make the market move more than usual, right? So the implied volatility is an indicator of price movement, and the skew in the horizontal, where the horizontal skew, when it shifts higher, when the implied volatility starts to increase on the shorter dated options, that could signal something is indicating that the market thinks that stocks are going to move, like the market's going to move in either direction. One is that the implied volatility itself is the indicator of market expectations, based volatility going up or volatility of the market going down.
And I think we should skip question 8. It's a little too pluggy for both of us. I think you guys obviously have a bunch of option tools and we do too. So I'm going to skip that if that's all right.
Yeah.
Looking at different products, whether you're talking about comparables, let's just say you're looking at a bunch of technology stocks or a bunch of indices, do you look at like volume distribution across them and see how they vary? For example, SPX volume is greater or less than NDX, greater or less than RUT, or Apple's greater or less than IBM, greater or less than Oracle. And what insights can traders gain by comparing these patterns between like products?
For products like that, actually, the SPX has by far the most volume. The other ones that have little volume compared to it. When we look at them side by side, the SPX just swamps all of them. They're not close. If we look at SPYTQQ or something, like maybe they're a little bit closer, but the other ones are not that close. But what we do is look at volume on a relative basis, relative to itself, and is it moving up relative to everything else. So if volume is moving up relative to itself, and volume across the board is doing that, then it's like the whole market, right? And volume is increasing everywhere. But if you're looking at a particular product, like you said, where the volume on a relative basis, something like for Apple or IBM is moving higher, for just that particular stock, but we're not seeing the same thing in other places, then maybe you pay attention to what's going on in there. It's not a systemic or market specific, it's a stock specific that's going on. Something's happening in that stock.
So it seems like it's more percentages. Like if stock A usually trades 20% of the volume of stock B and they both go up, it's okay, this makes sense. Or if they both go down, but if stock B all of a sudden goes up and stock A volume goes up and stock A doesn't, or vice versa, then all of a sudden it hits the radar. And okay, maybe we should drill down and look at some other. Obviously, you got to look at a ton of data to make sure,
Right.
but it catches your attention, it sounds like.
Exactly.
And looking at today's market environment, you talked to obviously the zero dated option expirations and some longer term ones, but what are some of the most noteworthy patterns you're currently seeing in single leg index option volume? And what might these suggest about like institutional expectations for the market direction in the coming months?
Yeah. From day to day, there's a lot of volume in zero-DTE. By far, there's a lot more volume in the zero-DTEs than other expirations. But that's what we typically see in that. And you're looking for something maybe different, right? Something unusual. that happens from day to day. It could happen intraday. And that you're looking for a combination of the unusual volume and what was the impact, price impact or implied volatility impact due to that volume, and trying to then take it from there. So it's very dynamic. Whatever has happened yesterday may be different today, could be different in an hour. So I couldn't give you an answer like what's unusual right now, but that's like what the two key metrics you're really starting point is volume and price impact.
And this has been great. It was a great webinar earlier today. As always, a great podcast. But any final thoughts you'd like to, any final thoughts for our listeners?
Yeah, I think that as any trader, one of the things you want to do is have tools in place to help with your decision-making process, especially if you want to know what's going on. What are other people doing and what is that indicating relative to market expectations? And looking at these single leg options, because they're liquid and have a lot of trading going on and reflect market expectations as systemic expectations, is something that you should consider looking at from day to day in your trading decisions.
Will and Dmitry from MarketChameleon, thank you guys so much for stopping by. For our listeners, you can find more from Will and Dmitry at their website, MarketChameleon.com, or on our website under education. They are frequent contributors to webinars and podcasts. You can catch their webinar the second Tuesday of every month. And once a month, we put out a podcast as well. And you can go to our site and click on podcasts and see all the past ones as well as ones that will be coming upcoming. Guys, thanks a lot. Really appreciate you guys swinging by the studio.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For information on the uses and risks of options, you can obtain a copy of the Options Clearing Corporation Risk Disclosure document titled Characteristics and Risks of Standardized Options by going to the following link: ibkr.com/OCC. Multiple leg strategies, including spreads, will incur multiple transaction costs. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.